Good morning, welcome to Inside India. I'm Dan Murphy. Let's get straight to your headlines this hour. First, Asia markets in the money following fresh data out of China. Annual GDP came in line while quarter-on-quarter expansion topped expectations. But demand is still weighed down by a property downturn and trade tensions. Key issues on the agenda at this week's plenum in Beijing. Japanese stocks leading the charge in Asia on hopes that fiscal dove Sane Takaichi will become Japan's next prime minister. This after the leader of the smaller Japan Innovation Party said it's meeting with LDP lawmakers to discuss forming a coalition. Meantime, Indian shares are tipped for a higher open on strong corporate earnings and on signs of easing China-US trade tensions. But President Trump issuing fresh comments vowing massive tariffs on India until New Delhi stops buying Russian oil. Okay, let's take a look at how Asia markets are performing today. Singapore and Malaysia are, of course, closed for a holiday, and investors assessing a raft of Chinese economic data, which shows Q3 GDP growth slowed to its weakest in a year. The PBOC also keeping its loan prime rate unchanged as expected. In terms of where we stand right now, you can see the major markets are in positive territory here. The Nikkei 225 better by almost 3% this morning, and green on screen across the board, including for the Hang Seng Index, which is up by around 2.5%. Of course, the Indian markets come online in about 45 minutes' time. So here's what Nifty futures are currently indicating as we track into the resumption of trade. Well, CNBC's Elaine Yu is in Shanghai as China's fourth plenum is set to begin, where the next 5-year plan will be set. As we mentioned, it comes as China's GDP number comes in softer than the previous quarter. So, Elaine, what's your take on this? Does it change any of the calculus around the new 5-year plan? And what else can we expect to happen over the next few days?
Hey, Dan. So this softening of growth has been expected as U.S. tariff bites, which goes to underscore for Beijing the kind of volatile geopolitical environment that it is in. And so on this occasion of the fourth plenum and also in the past year, given this geopolitical context, President Xi Jinping has been doubling down on the message of tech self-reliance and also tech innovation as what drives China's economy in the coming years, along with what President Xi has called developing new quality productive forces. And so with the tensions with the West, tech sanctions and restrictions as well, particularly from the U.S., is where China is really doubling down on this tech self-sufficiency, which it started in even the 14th 5-year plan, the previous one. And now China's state news agency Xinhua has described the coming 5 years, the next 5-year plan from 26 to 2030, as a crucial phase for solidifying this goal of what Beijing has described as a national rejuvenation through Chinese-style modernization. And it therefore carries unusual weight, the state news agency said. And President Xi is quoted as saying what is most essential is developing that high level of self-reliance and self-improvement for China's survival and development. So strong language here, and also to strengthen China's scientific and technological innovation. What is less clear is what kind of a path Beijing has in mind for boosting domestic consumption, which it has been talking about, and a lot of eyes are on how China might economically rebalance its growth model from relying less from exports and investment. It's very supply-heavy playbook, which has been around for years, to more towards domestic consumption. And there could be more emphasis from this fourth plenum as well on social welfare, improving people's livelihoods, which could in the long term boost that, expand that consumption domestically as well. And this is a critical week for Beijing. In addition to the fourth plenum, we have Treasury Secretary of the U.S. Scott Bessent and Vice Premier of China He Lifeng expected to meet this week next week in Malaysia at the ASEAN summit. They had a video call which the two sides both described as candid or frank and also in-depth. And Xinhua said they have agreed to a new round of trade talks as soon as possible. And of course, with the Trump-Xi meeting scheduled for South Korea later in the month, a lot is at stake for China's economy and strategic goals as well, Dan.
Okay, Elaine, we'll leave it there. Really appreciate the update. Thanks again for joining us today. And it might be the Diwali holiday in many parts of the world, but India's market does remain open today. CNBC TV 18's Hormaz Farakia has a preview of what to expect in the week ahead. Happy Diwali, Hormaz. Welcome to the program.
Thank you, Dan. Happy Diwali to you as well and to all your team. It's been a very quiet year, if you could call it that, for the Indian markets from the previous Diwali till today. And if you take a look at the returns when it comes to US dollar terms, the Indian markets have been underperforming the other global peers, be it the Kospi, be it the S&P 500, be it the Nasdaq. The Indian markets have delivered almost negative returns below 0%. The others have seen more than at least 15 to 35% worth of returns in US dollar terms. But what has remained buoyant, though, all through the year has been India's IPO market. We've seen fundraisings worth almost $50 billion and counting so far. It's been that kind of a year for India's IPO markets. But the things are now starting to look up with the series of reforms that have been announced with regards to GST and so on, the income tax cuts, the rate cuts from the central bank as well. The auto sales figures were very robust for these festive days as well. Auto companies reporting robust numbers. The Confederation of Indian Traders expecting sales for the Diwali period to be in excess of $50 billion. So that is another positive update that is coming in. The Indian markets were functioning today. They will have a special 1-hour trading session tomorrow from 1:45 to 2:45 p.m. Indian time. We'll have a holiday on Wednesday and we move on to business as usual over Thursday and Friday. But for the road ahead, the earnings season so far has been in line with expectations or even better than the subdued expectations that were there. The markets have now started to move up considering the foreign investors who have been at record short positions at the start of this month. They have begun to cover some of their positions as earnings start to trickle in as well. The banking index is already at a record high and the benchmark Nifty 52 is nearing a record high of its own. So it was a quiet year, but the bulls will definitely be hopeful that this upcoming new year promises to be one with healthy returns for everyone.
Really interesting, Hormaz. Okay, appreciate the update. Thanks again for being here. Moving on now, and President Donald Trump has been speaking to media on board Air Force One. The president touched upon the U.S. relationship with India. Trump said that India's Prime Minister Modi had assured him that India will go ahead with plans to restrict its purchases of Russian oil. Oil markets looking like this right now. You can see down for the start of the week. WTI 57.28, Brent just above $60 a barrel. Both contracts down by around 0.4%. Well, for more on this, we turn live now to Trine Nguyen. She's a senior economist at Natixis, joining us live now for a pulse check on what's happening with the markets, the economy, and of course, what to expect in the week ahead. Trine, I think we have to begin with what we've just heard from US President Donald Trump suggesting that these massive tariffs on India are likely to stay in place unless we see genuine change when it comes to the purchases of Russian oil. Not necessarily a new narrative here, but can I get your reaction to what the president has just said?
I do think that tariffs between the U.S. and India will go down, and I think there are signs that the talks are going well. One good sign of that is just that if you look at oil where it is today, we're not in an oil crisis. So the arbitrage between buying Russian now versus during the energy crisis is very different. So from the Indian side of view, it has a lot more to lose than to gain as long as this 50% tariffs are on. So I do think that we can get that at least out of the way. It's a question of how do you manage this narrative economically from its own interest. I don't see the need for India to continue to have significant purchases of Russian oil. They can slowly scale that back. And India is also motivated to resume trade relationships with the U.S. Because if you look at the September data, you already see the impact of 50% tariffs on Indian exports to the U.S., which is its largest market. And even if India were to try to increase exporting to other markets, particularly the BRICS countries, the fact that China data today shows that retail sales are weak and industrial production is accelerating, means that India is going to end up importing more from China than being able to export of that out. So it's facing pressures, not just through Trump, but also the fact of China trying to export its deflation to the rest of the world with a narrow market, meaning more of that is coming to India, with India facing the biggest trade deficit with China in Asia. So India is very wary of this. And the second factor is really the medium-term impact of this trade tensions, prolonged trade tensions with the U.S. Obviously, most of the tariffs are pretty much exempt. Only 55% is targeted to this 50% because pharmaceutical, ICT, and so on, the areas where there's a lot more growth, are not impacted. But the reality here is that escalated tensions means that you could potentially facing sectoral tariffs that other countries can get reprieve and you're not. And moreover, India's potential is not what it trades with the U.S. today, but what it will trade with the rest of the world, given the fact that it has the largest population and it really wants to grow this job area in manufacturing. So growing outward in every way possible, particularly to its largest market, is still a big consideration for the Modi government.
Trine, to your point, we are seeing this 50% tariff really take a bite in certain sectors of the economy. As you mentioned, exports to the United States are down. Do you expect the US and India to strike some kind of mini trade deal before the end of the year, or is the timeline going to be longer than that?
Absolutely. I think we have a lot of trade deals to expect out of India. First, lowering the 25% tariffs is something that India can do, and it will try to do that, as well as potentially even get the 25 to 20% what the Southeast Asian get. So that 20% level, if the hits are taken by the Indian side, the importer side, and a third of it's passed on to consumer, then the tariff itself is not going to bite significantly. Another trade deal that India is looking at is also the EU FTA. The EU is also a very significant market that can potentially import, and if not the only market that can offset some of this decline of U.S. imports. And I do think that the India side, as well as the EU, both are very motivated to diversify from too much dependency on the U.S., too much dependency on importing from China, and so on and so forth. That gives it a motivation for India to continue to look outward. So my thesis of India continue to grow via trade is one that I think will hold in the medium term. And to get to the medium term, we need to get to these trade deals probably end of 2025, if not to be implemented in 2026.
So, Trine, how sustainable is India's trade deficit if we do see global liquidity conditions actually tighten over the coming quarters?
Well, the issue with the Indian trade deficit, particularly the one with China, is that, well, obviously India deficit with Russia or oil majors is because it needs energy to grow. And even if it's growing, it's renewable. Fossil fuel continues to be very important across Asia, not just India. The second thing is deficits with China. And a lot of, actually, in fact, it has a deficit with every single Asian country except for the Philippines. Particularly its deficit with China points to the fact that, not just be the fact that it needs intermediates for all these new iPhones that's sampling and other ICT sectors and pharmaceutical, but it also is importing consumer goods and capital goods. And that points to the fact that India fundamentally has a lot of room to grow in manufacturing, not just exporting to the US and exporting to the EU and the rest of the world, but within itself, because that is domestic demand not being met by Indian supply of manufacturing. How are we going to get there? Why are the Indians importing rather than producing it themselves? They're importing because of red tape, right? Red tape, for example, we had this labor reform that was passed that raised the threshold of not needing to involve the government from 100 employees to 300, but that hasn't been implemented. So I think significant reforms are so needed to really reduce this risk of exiting and creation of firms, which basically has contributed to Indian entrepreneurs not taking those risks, and they're willing to import rather than take the risk of opening a manufacturing firm within India itself to serve the Indian domestic market. So sustainability-wise, I do think that is a major issue. The issue is that while it can sustain this via the exporting of services, via importing capital, fundamentally Indians themselves need jobs. And the issue with India is that the informal sector is too large and there's not enough formalization of jobs. And so continuing to import from China will lead to this industrial base eventually getting eroded without even being critically created in the first place. And that, I think, is a risk over the longer term that will not just a macroeconomic risk, but also political and social economic.
Trinh, we've spoken a lot about what's happening on the external side. Let's zero in and just double click on what's happening with the Indian economy domestically right now as well. You and I have spoken before a couple of months ago about the GST rationalization and how this was meant to spur consumption ahead of Diwali. You're tracking the numbers in real time at Natixis. Are you seeing any evidence that the changes that we've seen to GST are actually impacting the consumption story right now?
Absolutely. So if you look at Indian growth, it's been pretty resilient. As mentioned, the impacted sector to tariffs are still very small. So the GST itself is supposed to offset that. We expect that to be meaningfully impacting consumer price. So that means that purchasing power is going up as goods price go lower. And the big question I suppose one would ask is that the Diwali impact is certainly there, but after that one-off pent-up demand, and historically, if you look at the spending in the month leading up to Diwali, it's been a huge spurt. But then you have the payback in November, right? So how do we sustain consumption growth moving forward? To sustain that, you have multi support happening, which is liquidity support through the central bank cutting rates, but also easing conditions. You have some fiscal support through GST, but fundamentally you need to grow jobs, right? You need to be able to facilitate the private sector capex to rise. There are signs of private sector capex broadening, but it's still very concentrated in core sectors like infrastructure, energy, and so on and so forth. We need to broaden further. So I do think that beyond Diwali spurt, for India to really grow beyond the 6-ish% to go to the 7 to the 8%, which will require significant capex on the private sector side, that will also lead to much more employment, much more formalization of jobs, and that will spread out throughout the economy in supporting growth. Right now, we are seeing green shoots from a very good rain season for the rural-urban income. Urban is lagging behind, but as mentioned, some of these factors are offsetting some. But irrespective, we expect a slowdown going into the end of the month with the GST story giving a short-term boost.
And adding to the consumption story as well, we've already seen the RBI cutting something like 100 basis points. How much more room do you think the RBI has to do the heavy lift on the consumption side before inflation once again becomes a concern?
Well, the good news is inflation is not a concern, right? Even though the rupee has been depreciating year to date to help offset some of these tariffs, is the fact is that we have ample food supplies, as mentioned, which has helped the rural sector quite meaningfully because most of Indian employment is still in the agrarian sector. The second aspect is also the fact is China's exporting deflation. The fact is that India is flooded with Chinese goods means that in the short term, goods are lower and energy prices are much lower as well. So you have food, energy, and goods going lower, pushing inflation lower, and that therefore real rates are rather high in India, right? So the question is not whether there's room for cut, it's a question of when the RBI does cut. Given the fact that the dollar has resurged as of late, and the rupee has been weakening because of this trade tensions and so on and so forth, it's actually caused some short-term pausing of the RBI. But I do think that looking ahead, we still have room for another probably 50 basis points of rate cut. They will especially if the trade deals doesn't come through, they will need to use the rupee as a shock absorber, the first line of defense for the Indian economy. And even if you were to get these trade deals going through to lower U.S. tariffs, I would still expect another at least 25 basis points from the RBI to really support liquidity conditions. Credit growth is stabilizing, is rising a bit, but remains subdued. So I do think that there's room. And it's actually, despite of all the negative news and the fact that Indian equity is underperforming other countries who are basically catching up, the reality is you do have fundamental supporting the country. You know, it's looking at this crisis with oil ample, food ample, plenty of room to move.
I really like that line, the shock absorber, the first line of defense on the rupee. At 87.95, though, you also have to wonder how much lower can rupee go?
Well, it really depends on the dollar picture, right? So we expect the dollar to depreciate, given the fact that we expect the Fed to cut rates into 2026 pretty aggressively to 3%. Now, with that, then that gives support to the Indian rupee and generally the broader Asia picture. Now, what's dragging the Asian FX down is really the fact that U.S.-China tensions are escalating, and that gives us a very murky picture given the fact that we're all in Asia and regionally we're affected by this. But fundamentally, after the shock, I think the rupee itself will continue to stabilize. It is, given low inflation, I do think a weak rupee policy is where the RBI is heading. That said, there is a threshold in which they don't like, because depreciation expectation can build on itself. So I do think that they wouldn't want excessive volatility of the rupee. But if you look at where reserves are, I think it's policy to help compare competitiveness. You can compare that, you know, a country that has depreciated even more is really Vietnam, right? The VND has, the SPV has been taking such a very weak dong policy where despite growth was like gangbuster above 8%, they continue to weaken the VND. Why? Because it's a big trader economy. And I think for India, generally speaking, a weak rupee is not something they would want, particularly in a high inflation environment. But at the moment, we have very soft inflation, and real rates in India are really high. So for investors, I think it's increasingly looking attractive. It's attractive in terms of real, you know, look bond yields. Where else can you get such high real return?
Okay, Trinh Nguyen live for us from Texas. Always appreciate the conversation. Looking forward to speaking again soon. Stay with us here on the program. Inside India is back in 2 minutes. Welcome back. You're watching Inside India. Here are some of the stories we're keeping tabs on today. First, the latest from the conflict between Pakistan and Afghanistan. The two sides have now agreed to an immediate ceasefire after a week of fierce border clashes. The truce talks held in Doha and mediated by Qatar and Turkey will resume this week to discuss more detailed matters. The clashes broke out after Pakistan accused the Afghan government of supporting and sheltering groups working against Islamabad. The Taliban denies the claims and has agreed to not do this as part of the ceasefire. Elsewhere, tensions were reportedly running high during a White House meeting between President Trump and Ukraine's President Zelensky. Trump reportedly urged the Ukrainians to surrender territory to Russia, a notion rejected outright by Zelensky. Trump later denied these reports and stated to media that a ceasefire could be established along current battle lines. A request to the White House to supply Tomahawk missiles to Ukraine has also not been yet decided upon, according to Vice President Vance. And priceless jewels were stolen from the Louvre on Sunday. Thieves breaking into the world's busiest museum at around 9:30 a.m. local time, shortly after it was opened to the public. 4 perpetrators used a freight elevator to enter the gallery through a balcony, cutting through glass and smashing display cases. They escaped on scooters with 8 artifacts, France's culture minister saying the group was, quote, very professional. The heist took place in under 7 minutes, the museum shutting its doors for the rest of the day, citing exceptional reasons. Turning now to the Indian earnings season, and Reliance Industries missed profit expectations for the September quarter. Net profit rose to almost 182 billion rupees. That's up from 165.6 billion a year ago, which was below consensus. Growth in its retail and digital units were eclipsed by weakness in the oil to chemicals and polyester businesses, which weighed on overall profits. Revenue, though, came in slightly above forecasts. Meantime, Reliance says it is continuing to pivot towards consumer, digital and clean energy businesses. Its Jamnagar clean energy project is expected to start commercial production as soon as next year. It also plans to list its telecom unit Jio by mid-2026. In the banking space, HDFC Bank posted better than expected earnings for the second quarter. Net profit at India's largest private lender by market cap rose to 186.4 billion Indian rupees, up from 168 billion a year ago. Net interest income rose, but lending margins narrowed to 3.27% from 3.35% in the previous quarter. The bank's CFO says margins should recover in the coming quarters. A major boost came from trading gains, which climbed nearly 24 billion rupees from just 3 billion a year earlier. Asset quality also improved, with bad loans easing to 1.24%. Up next on the program, Diwali festival season kicks off today and India is buzzing with shoppers and travellers. So what's fueling the surge and which cities are topping Diwali travel lists? We'll tell you more on the other side of the break. Stay tuned. Good Monday morning. You are live on CNBC. Let's give you an Asia market pulse check right here, right now, as we track into the broader trading day. And you can see here most markets across the region are indeed in positive territory today. Take a look at this. The Nikkei 225 up by around 3% as we speak. We're also seeing solid gains for Hong Kong's Hang Seng Index, up by 2.46% as well. Malaysia and Singapore both closed today for a holiday. As I mentioned, we are counting down to the market open in India as well. This is how we're shaping up as it stands. Of course, the Diwali celebrations well underway now. Nifty futures are looking like this. And I mentioned Diwali celebrations kicking off today, and the festive rush is in full swing in India. Markets and temples across the country lit up over the weekend as families stocked up on gifts and decorations for the Festival of Lights. And it isn't just local foot traffic that's booming. Travel data from Agoda shows Diwali has become a major magnet for both domestic and international travelers. Searches for trips within India are up 18% during this holiday period, while inbound interest from overseas has surged 67% year on year, led by huge demand from South Korea, Southeast Asia, the UAE, and the United States. So what's driving this spike in travel during Diwali, and which destinations are attracting the most visitors this season? Well, here to offer a view is Hari Ganapathy, the co-founder and CEO of the booking platform Pick Your Trail. Hari, welcome to the program. Great to have you on today. So first of all, happy Diwali, but also tell me, what is driving the latest trends that you're seeing on Pick Your Trail right now?
Thanks for having me on the show. Happy Diwali to you too and all the viewers. I think this festive season is generally a booking period for Indian travelers, and there's a lot of leaves around, and a lot of kids also have school holidays. So that's what's driving traditionally the demand. But also, like you said, a lot of visa on arrival destinations and combined with low airfare, low-cost carriers is driving a lot of new age traveler demand as well.
It's interesting, I was looking over some numbers, and according to your own stats here, Indians are booking holidays 50 days ahead now versus 40 days last year. What does that tell us about consumer confidence and disposable income heading into this really important festival period?
I think clearly international travelers are a subsegment of the overall Indian economy, which are in some sense not extremely affected by what's happening all around, as a lot of discretionary spend holidays are. And what it clearly shows is Indian travelers are getting mature. They're realizing that booking early gives them advantages in price, availability, and as they seek out more experiences, they're realizing that in extremely smaller, quainter towns, availability is becoming a big challenge. And this is an average platform level. If you look at long-haul destinations, this number is even higher. So I think it's a very healthy trend. Internationally, Europeans, for example, plan their holidays even 4 to 6 months in advance. Indians are known to be last-minute bookers, but it's good to see that they're catching up with the long-term booking window as well.
Do you think people are locking in early as well because airfares and hotel rates are perhaps rising faster than inflation right now as well? There's a cost element to this too.
Yeah, absolutely. You're right. I think if you're able to book ahead, you get extremely good steal deals on airlines. They also are looking at the load factor. So you tend to get airline fares which are extremely cheap compared to what you would get if you're booking, let's say, 2 months in advance. So I think, yes, you're absolutely bang on right there.
And give me your own anecdotal evidence as well. Are you seeing any reaction among your client base right now or your users as a result of the weaker rupee? And to a broader point here, global macro headwinds as well? Or is the Indian traveller still happy to travel and spend abroad despite what we're seeing happen with the currency right now?
I think currency movements do play a role. For example, destinations where Indian rupee is getting stronger, we are seeing some bit of movement. See, I think airline and hotel is one part of the spend. What we have seen, and using our own estimates with user studies, people spend anywhere between 20 to 40% of a holiday spend in destination. So Indians are one of the largest in-destination spenders on shopping and food, right? So I think there, the decisions of the currency make a difference. So for example, destinations like Japan or Sri Lanka, where Indian currency is slightly doing better, we're seeing a lot of movement to those destinations as well.
Can I also ask you about where travelers are actually going as well? You mentioned Dubai is back. Vietnam has also been hot all year, according to some more anecdotal evidence as well. What would you say is actually driving the inbound travel to these destinations? What's hot right now? What's not, and why?
Currently, I think if you look at it, 2, 3 buckets in which people are traveling. One is your entire events led, so Northern Lights. We just finished the entire migration in Africa. So I think those events and music festivals, these are things that are driving one set of demand. That's one set of destinations. F1, for example, also falls in the category. Otherwise, right now, like you said, Vietnam has been doing really well this year, and Japan too, both driven by easier visas and better connectivity. Vietnam, in fact, there's a small island called Phu Quoc, which is visa on arrival if you're flying directly into Phu Quoc. So, in fact, some travel companies have also launched exclusive charters into Phu Quoc. I think it's also a signal of maturity of the Indian traveler. While there are destinations for first-time travelers, travelers are also getting smarter. They're looking at destinations which they can kind of decide in a very quick time frame. And if the airfare, which I think thanks to low-cost carriers, continues to be competitive, they're able to kind of quickly make a decision and travel. I think that's what's driving a lot of last-minute travel. And destinations like Australia, Europe, which are traditionally long-haul, which have visas involved, I think customers are planning well in advance because the average spend is at least 1.5 to 2 times more than some of these shorter destinations. So it's still a pre-planned getaway.
Indeed, and that's what makes this so interesting as well, because I also think it's fair to say that we're seeing the travel operators, the airlines, global tourism departments as well, getting much more sophisticated about how they attract the Diwali traveller too. This has become such an important holiday period on the global travel scene now, and indeed it is attracting a lot of interest from these tour operators around the world in places like Japan, for example, which historically may not have necessarily attracted the Indian consumer. So, Hari, what do you see as the market that's going to be driving the most growth going forward? Where do you see the best opportunity for these businesses who might be actually operating in the travel space, looking to tap into this really lucrative and growing market?
So I think India's, like you said, a lot of tourism boards are also focusing on India as next big source of market. I think for the next 10 to 15 years, the Indian outbound story is very, very strong. And there are multiple segments of customers emerging. So for example, the entire, like I said, festivals / sporting events is a set of people traveling, right? And then there's the honeymoon and family segment that continues to be there. I think what's happening is the tourism boards are trying to also make it attractive for people to come back. For example, ski tourism is picking up in some European countries, right? So I think what is happening with the Indian consumer is while there is a lot of demand from your top 8 cities or metros, there's a lot of demand also coming in from your ancillary cities, right? Tier 2 cities. And with the Indian government's push on UDAN, which is our regional air connectivity initiative, there's a lot of connectivity just being established in these tier 2 cities, and a lot of low-cost carriers also getting slots to connect some of these cities, right? So, which I think is getting direct flights into these holiday hubs from tier 2, tier 3 cities, which is actually expanding your overall addressable market. So they're not coming into Bombay or Chennai or Gurgaon to fly out. They're flying from Pune, they're flying from Trichy, Kochi, Vizag, which I think augurs really, really well.
Indeed, and I also think that if spending power and incomes continue to rise, then this segment of the travel market is going to be one to very closely watch. Hari, just on another point here, you mentioned the long-run trajectory for external India tourism. What is your forecast for the year ahead as well? And do you think outbound travel will still see double-digit growth ahead, or are we nearing a saturation point?
I think we're nowhere close to a saturation point. I think we're just getting started. Obviously, macroeconomic factors, overall stability in various pockets of the world do affect customer sentiment. I think it is a fact. That's what makes it exciting about the entire industry. It's not just your own strategy which defines growth, but a series of other factors. But I think in the medium term, the Indian outbound piece is very solid. There is rising income levels, and people are looking at travel now as a lifestyle from a discretionary spend, and especially the younger audience, 23 to 30, are increasingly looking at amassing experiences, not necessarily materialistic items. So I think post-pandemic, the push on experiences has been real, and that's going to continue to drive. And you're seeing, people traveling for Northern Lights, ski, sporting events, and I think that's going to continue to drive the Indian outbound. And I don't foresee why we would not go at a healthy double digit for the next 5 years CAGR.
Yeah, it's a good point. And as you say, there are significant macro tailwinds as well. Of course, not just lower RBI rates, for example, and improving liquidity and credit conditions, higher incomes, the demand for experiences post-COVID, all playing into this as well. Hari, what would you say is the biggest risk to your double-digit growth thesis there? And is there anything that's giving you pause for thought or concern about what could potentially happen when it comes to India's overall travel and the outbound market moving forward?
It's a very interesting question, something we keep discussing internally as well. See, I think clearly what's happening in the US and what's going to happen if something happens in the US, I think will have worldwide ramifications, and it might kind of have some trickle-down effects as well. But if you see, a lot of now Indian push also is towards local manufacturing and local self-sustenance. So I think some of that may be offset by what's happening within India. I think in the last 3 to 5 years, India has kind of absorbed the shocks of the global markets quite well, I would think. But I think that's going to be one of the biggest question marks, so to say. What's going to happen in the global economy? How much is India going to get affected? But one thing for sure on the outbound side is what's going to happen if India is not affected too much is that a lot of these economies, Indians are going to come in and spend. So I think Indians are going to be a lot more welcome, and local tourism boards would be looking up to India, to be in the top 3 to 5 in terms of remittances and spending, I think.
Okay. Hari, before we let you go, how are you spending your Diwali? Looks like you're going to be in the office, my friend.
No. So I think we try and support some bit of customers also. So I think that's why in office. But I think now it's going to be with family and bursting some crackers and eating a lot of good food.
Sounds good. Sounds good. Okay, we'll leave it there. Hari, really appreciate the conversation. Thank you so much for being here. Hari Ganapathy there from Pick Your Trail with the latest travel trends during Diwali. Thanks again. And we are counting down to the market open in Mumbai. Stay with us. We are back in 2 minutes' time. Welcome back to the program. Indian markets are coming online. Let's go straight to the wall to check how the markets are opening up on this Monday. And of course, as we track into the Diwali celebrations as well, the Nifty 50 is in positive territory here, up by 0.7%. Thank you very much. 25,888 is the level. We are seeing some rupee strength as well coming through here. 87.88 is the level right now as well. And we're in the thick of earnings season in India too. Reliance Industries missing profit expectations for the September quarter. Net profit rose to almost 182 billion Indian rupees. That's up from 165.6 billion a year ago, which was below consensus. Growth in its retail and digital units were eclipsed by weakness in the oil to chemicals and polyester businesses, which weighed on overall profits. Revenue, though, came in slightly above forecasts. Meantime, Reliance says it is continuing to pivot towards consumer, digital and clean energy businesses. Its Jamnagar clean energy project is expected to start commercial production next year, while it also plans to list its telecom unit Jio by mid-2026. You can see the stock is up around 2.7%. Take a look at the banks as well. India's top two private lenders, HDFC Bank and ICICI, both reported higher than expected profits for the September quarter. The banks also said they saw improvements in asset quality as well. And outside of earnings, RBL Bank is planning to enter the wealth management space following a $3 billion investment by Emirates NBD. Emirates NBD is buying a 60% stake in RBL through a preferential share issue, marking the largest cross-border deal in India's financial sector. The merger is expected to take effect in April next year, making RBL a listed subsidiary of Emirates NBD. Well, Kamal Dimic is partner and portfolio manager at North of South Capital. He joins us live now from Dubai for a pulse check on these markets and also some of the other trends driving his investment strategy right now. Kamal, welcome to the program. First of all, look, let me just ask you, because based on your own notes here, you've actually largely been out of India since 2021. So help me understand what you think is broken in the India story right now, or if enough has changed for you to want to dive back in. Good morning.
Yeah, hi, good morning. That's right. Look, we're global emerging market investors and we're also quite value driven. So that would already explain why we've been more cautious on India. We like the India story, the long-term upside, of course, from the rising middle class. Everyone understands that. But we do look at valuations, and valuations are really important when you're making decisions on the equity market, because if you end up overpaying for a stock, you overpay for future earnings, then even if that earnings growth does come through, at some point, earnings growth slows down and the multiple starts contracting, and the losses you can make on that are very, very significant. We've seen this, we've had this experience, in China, where China was a very, very popular market for a while, driven by internet stocks. People paid up very highly for those stocks, and they've ended up being extremely poor performers, even though actually they have delivered very substantial earnings growth. So our concern around India was that we were in a similar sort of situation. The Indian market has always been a little more expensive than other emerging markets. So you can think of it on PEs of 12 to 18 times, let's say, for the Indian market versus the rest of the markets at around 10. But really, since 2021, there's been a fundamental shift in the valuation of the Indian market, a re-rating towards a range of 18 to 24 times forward earnings. And we're currently trading, give or take, around 22, so probably towards the higher end of that range, although clearly off the highs, as the Indian market has underperformed over the last year or so, certainly. And also other emerging markets have re-rated with a renewed interest. So, valuation has been the key issue. What hasn't helped, certainly over the last year, and what's, I think, driven part of this re-rating, is that earnings growth has started to disappoint in India. As long as your earnings are growing and you've got constant positive surprises, that helps support even high valuations. But what we've started seeing is that people have had to downgrade their earnings forecasts. So if you look at forecasts for the current year, consensus forecasts for the market, they're about 20% lower than they were 12 months ago. So people have been overly optimistic. There has certainly been a slowdown in growth in India, and in particular for the equity markets in earnings growth. And so that's led to this underperformance. On the flip side, that's us foreign investors, and foreign investors have been really the net sellers of India on the back of this. We've been out probably earlier than most, but I think globally investors have been a little more cautious. On the flip side of that, though, you still have a very, very strong demand for equities domestically. You've got continuous growth and inflows from retail investors. And actually, they've now become a bigger part of the market than foreign investors, which has never been the case historically. So that's why the market has remained reasonably well supported, although it's clearly not performed as well as some of the other emerging markets. So where we are today is we're very interested by the fact that a lot of investors have sold out, and I think that offers opportunities. And there's certainly segments of the market that are looking a little more reasonable.
Okay, so walk me through some of those opportunities. As you say, earnings growth not necessarily keeping pace with the rich valuation that we see inside the India markets right now. And of course, these valuation concerns aren't necessarily new. Of course, within the EM space, India does trade at a premium historically. So where do you see opportunity right now, despite the richness of some of these stocks?
Yeah, I think some of the larger cap quality stocks that have historically been the preserve of foreign investors, where you have liquidity in the market, where these are fairly well-run companies that foreign investors get comfortable with. And some of these have become a little cheaper. So you look at the banking sector, for example, where valuations are at a premium to global banks, but maybe not as crazy. ICICI Bank, we've seen, of course, quite timely, we've seen numbers which are pretty decent. Credit quality is improving. These are very well-run businesses, and they're kind of the go-to stocks, I think, if foreign investor interest resumes in India. You've got other companies like Crompton Graves, for example, which again are not cheap in a global context, but have been derating over time. And they're interesting plays on the bigger Indian macro theme. So if you believe that Indian growth can resume in terms of domestic growth, in terms of domestic consumption, in terms of investment, which is what, of course, needs to happen. You had an excellent guest on earlier who went through all these drivers and issues for the Indian economy. Then those are interesting stocks to be looking at. I'll say again, they're not cheap. They're not something that gets value investors like us very excited. But India is now such a large component of global emerging markets that it's very hard to ignore these stocks.
Right. And looking more broadly at some of these macro drivers as well, of course, you're looking at individual stocks too. But as you make your picks here, talk to me about the impact of the rupee as well, because we've seen, of course, rupee weakening even as these other EM currencies strengthen. So why do you think India has missed the rally? How much of that rupee weakness is actually macro fundamentals versus capital flight as well? And for international investors, should they be concerned about this exposure to what could potentially be further rupee weakness from here?
Yeah, great point. So it's been a good year for emerging markets globally. And one of the reasons for that has been that we've had a period of dollar weakness, which we haven't seen, at least from an emerging market perspective, for, well over a decade. So historically, the currency for an emerging market investor has been a headwind. The dollar kept strengthening, your currency kept going down. And if you were based in the US or really anywhere else in the world, your returns simply weren't as good as they would have been if you had invested in, say, the US, where your currency was being stable. So that has reversed this year because there is a move away from the dollar. I'm not going to go into all the reasons why that is. I think that they're pretty well discussed. And that's become a tailwind for emerging market investors generally. And India really stands out as not having participated in that. And I think one of the reasons is portfolio flows. So what I said earlier, international investors have soured on the market because earnings growth hasn't been there. You've had money coming out of India, and the fact that domestic investors are buying doesn't support the currency. But also you're running an increasing trade deficit. I think gold prices have some impact on that as well. We've had a huge bull market in gold, and India is a huge importer of gold. That's also pushed the trade numbers. So all these things have, and of course, political noise, can't forget about that. And I know sounds like there's going to be some progress, and probably there will be some sort of deal. But India has been facing some of the highest tariffs and some of the biggest pressure from the US administration of any market in the world in recent months. So I think all these things haven't helped. Going forward, it's a tough call. I think forecasting currencies is always a little bit of a mug's game. Some of those pressures may ease, and that could support the rupee to some extent. But you will probably see rates coming down. And obviously, India at the moment has fairly high interest rates given where its inflation is.
Okay. Kamil, wish we had more time. We'll have to leave it there. Really appreciate you coming on today. Thanks so much for being here. Kamil Dimich there from north of South Capital. And that's all we have time for today on Inside India. Hey, thanks so much for your company today. Dan Murphy with you in Dubai. Stay with us here on CNBC. Access Middle East is coming up next.